Hey, this is Tom Nash, and we have a lot to talk about in today's video. Number one, Tom Lee just updated his best performing stock list, the granny shots, by adding 8 new stocks on that list. In this video, I'll go through it one by one and tell you what I think about it, what the fundamentals look like, and which of them is more exciting and which of them is kind of average, because not every single stock on that list is actually that good. On the other hand, he also went on CNBC and answered the most important question in everybody's mind right now. Will we have a post-Thanksgiving rally in the stock market leading to the end of the year? He actually gave a lot of interesting arguments, which I don't want you to miss. Now, before we start this video, the bottom line comes first all the time. So the 8 stocks, if that's what you're here for, are: number 1, Palo Alto Networks; number 2, Block Inc.; number 3, JP Morgan Chase; and then in his small to medium granny shots, he added IES Holdings, Sterling Infrastructure, Applied Industrial Technologies, United States Lime and Minerals, and Hims and Hers, a very familiar name on this channel because 3 years ago, when the stock was at $8 back in September of 2021, I put out a video saying, hey, this stock has a lot of opportunities for investors, and now it's actually trading at 30. So we on this channel, if you're a subscriber on this channel, you've been knowing about the stock for the past 3 years, and now Tom Lee also adds it to his list, which is not bad. It's a good confirmation, but we're not going to assume anything, because when we assume, we make an ass out of you and me. We're going to break down, analyze every single thing. But the first thing is, we're going to play the little clip from CNBC from that interview. We're going to hear what Tom Lee has to say about the potential of a Thanksgiving rally. And then we'll go through these 8 stocks one by one, analyzing them, breaking them apart, essentially letting you know which ones are shit and which one are legit. But as always, don't click nothing, don't smash nothing, don't buy nothing. Let's watch the clip, and I'll be back here in a second.
One thing we have to keep in mind is there's $7 trillion of cash on the sidelines, which I think in general portfolios are overweighted and risk-free. And I don't know if it's going to be 5% 2 years from now. So I think investors, as they're planning ahead and they're seeing an economy that's resilient, I think the case for equities is still very strong right now. I think the template that we think makes sense is buy things that either benefit from a dovish Fed or a Trump White House, which is small caps, cyclicals like the financials, the regional banks and industrials, and of course crypto, especially Bitcoin and some of the proxies like MicroStrategy and Semler Scientific.
But did you hear what we were just talking about? Can the Trump administration get away with the pro-growth policies and a dovish Fed at the same time? Because some of them work against the Fed being able to cut rates.
Yeah. I mean, I'd say the market is very skeptical at the moment. That's what we're hearing from our clients. But that also means that's room for positive surprise. And I think one thing to be mindful of is the Fed can be dovish even if there's resilient growth, as long as inflationary pressures and expectations remain intact. And so far, that's been the case.
Has it, though? We're seeing a little bit firmer core readings on inflation, and I guess it depends on what he does with tariffs.
Yeah, but if you look at survey expectations, whether the Federal Reserve Survey or UMich, we're seeing 5, even 6-year lows on inflation expectations. So we're back to pre-pandemic levels from what consumers see. And then if oil falls, as you know, that sort of pushes down the inflation forward curve.
Okay, so we just heard Tom Lee say, well, look, there's $7 trillion on the sideline. That's a lot of money. The markets are aching for all this new blood to get pumped into the system, with interest rates actually dropping, equities looking better and better every single day. It's inevitable that all this new money is going to be flowing into the equities market from the money market accounts, from the sideline, fueling the next rally, which is going to be more beneficial to some than others. And he actually named a few. He said, look, small caps, as always, Tom Lee small caps, cryptocurrencies, and financials. These are the 3 categories that he sees benefiting the most out of this new rally that's about to happen. Now, he also talked about the fact that the sentiment in the market that's gotten a little bit cooler, that people are not that excited about the Fed basically pumping the brakes. Essentially, that's a good thing. Now, is not spinning a bad thing. He's not making a shit sandwich into something that it's not. He's actually saying, look, folks, because people are not that excited about the Fed cutting rates anymore because they feel like inflation isn't coming down as fast as it should, maybe they're not that certain about it, there's skepticism. When the Fed actually continues their cut policy as scheduled, this will actually mandate the market to correct upwards, and it's going to kind of bounce back off this negative sentiment. So it's not bad, especially given the fact that he sees inflation is pretty much over. It's dead. The only thing that can spike inflation at this point is oil, but we're heading into the winter, and oil is usually at its strongest point seasonality-wise in July, August, September, not in December and January. That's the low season for oil. So he doesn't see any sort of path for inflation rearing its ugly head and essentially, putting a huge monkey wrench into this rate cutting cycle. Now, the more interesting part here is what he actually put out on his FS Insight note. But before I go through that, I just want to point out, he actually talked about that point as well on his newsletter and said, look, core PCE actually came on exactly like we all expected. Why is everybody so upset about it? 2.8%. The only thing that's slowing it down is magazines, and not the ones you put in rifles, obviously. But I mean, this is nonsense. We're heading to 2%. What do y'all guys want? Just relax. So Tom Lee says, look, we're heading to 2%. This core PCE number is on par. Relax. Now, he also says in this clip and on his website, on FS Insights, that Thanksgiving rally is happening. Now, on his website, he actually went a little bit more in depth than he did in the interview, and I'll tell you what he said actually. He said, look, number one, inflation is slowing down. Number two, we always have a post-election rally. That's just normal. Number three, we got a strong economy, so no recession. And of course, we have deregulation coming up with the Trump administration, and the cost of capital is coming down because the rates are coming down. So all this setup basically sets up the market for a really, really nice rally. Now, that's the logic that he's putting out there. I can't say that it's absolutely irrational. The one thing I'd say here is that even though he might be right on all these points, you have to remember that he's talking about the short term in the market. It's very, very hard to predict short-term market movements. It's very hard. I would almost say it's impossible. It's like trying to guess where grandpa, when he's drunk, is going to land when he's falling down. It's a completely random algorithm. So I would just say be careful with these short-term market predictions about a rally in the next few weeks. It's very, very hard to know. Don't forget, in the short term, the markets tend to be very rational. Long term, yeah, there's definitely a lot of fundamentals that drive the market, but short term, the market can stay irrational much longer than you can stay solvent. Don't forget that. Now let's go through the stocks in the granny shots. Now he has two classes of granny shots. The main granny shots, where two stocks basically remain solid in place, which is Meta Platforms and Tesla. We have done a full video on that. There's no need to repeat myself. But the three added stock that he just added a few days ago are Palo Alto Networks, Block, and JP Morgan Chase. So let's start with Palo Alto Networks. Obviously, it's a cybersecurity play. They score 70 on our MVP scorecard. It's not amazing, but still not horrible. Mainly the two issues there are the high PE and the fact that they're reducing their cash over time. It's not ideal. Now, if you look at the revenue growth, it's at 17%. It's okay. The rule of 40 here is 55, which is phenomenal. And over the past 12 months, we had net income grow by 500% with $8 billion in revenue and $2.6 billion of net income. That is absolutely incredible. But the thing with the stock is that according to a reverse DCF, which we ran on Stock MVP, this pricing right now of this stock at $390 assumes a 30% annual growth in revenues for the next 5 years, every single year for the stock, when in fact it's currently growing at 17%. So the current price reflects double than the current growth rate of the company. And that essentially just means you're putting a lot of future upside, a lot of future success, a lot of future potential that may or may not materialize into this current $390 price point. Now look, based on our 5-year model here in Stock MVP, in 5 years, this stock can range anywhere from 420 on the bear case to 640 on the uber bull case and 530 in the mid case. That's our 5-year price target for the stock. Now, let's move on to Block. Now, Block didn't score much better than Palo Alto Networks with just 75. Again, we've seen much, much higher scores. And again, here the problem is PE. The current PE is 50, but the good news are that the forward PE of the company is actually coming down to 20, which is going to upgrade its score next time we do this to 80, and that's really not that bad. Now, the company actually increased its cash position over the past year by $3 billion, and on the surface, that looks very impressive, but the problem is that that was mostly empty calories. It was mostly debt. On the Stock MVP cards, you can see that they've added $2 billion of debt, and that is the base of that increase. Another 800 million in net income, but that 3 billion is 70% debt. So that's not that exciting, especially when a company has about 5% of operating margin. Just not something that I get excited about. Now, the stock is currently trading at $88. Our 5-year price target for this stock based on the SCF model here in Stock MVP is 83 in the bear case, 105 on the medium case, and 127 on the bull case. Really nothing that exciting. Now, JP Morgan is an interesting play here. I don't know if you're into financial sector. I'm personally not. But if you're looking for a financial sector investment, if you're looking for a bank to invest in, I don't think he's wrong about this. Now, look, the stock scores only 75 on our scorecard in Stock MVP. The growth is only 14%. It's not exciting if you compare it to growth stocks. However, if you're looking for a financial sector play, a bank, not that bad. Look, we have $54 billion of income, 60% operating margin. That is actually not bad. But the beauty of this only comes out when you compare JP Morgan to Wells Fargo and Bank of America. When you put it side by side, not against Tesla, not against Palantir, when you put it side by side against banks, then you actually see that's not a bad choice for a bank if you're looking for one. Look, JP Morgan is actually growing at 15% year over year. Bank of America is -2. Wells Fargo is -0.5. Net income of JP Morgan is almost 5%. It's -23 for Bank of America. It is basically 0 for Wells Fargo, 0.3. Net income is $54 billion. Bank of America is half that, and Wells Fargo is even less at 18. Operating margin is 58%, almost 60%, way higher than Bank of America with 38% and a lot higher than Wells Fargo with 30%. And the forward PE is 15. With Bank of America being at 13 and Wells Fargo at 13.5, they're pretty much identical. So you're getting the best bank of the three at pretty much the same price, and it is considerably better than the other two we just looked at. So if you're looking for a bank, JP Morgan is probably the best choice out of these three. But again, you have to do your own research. You have to make up your own decision. This ain't financial advice. I'm not telling you to buy JP Morgan. I'm just showing you how to analyze these stocks. People compare JP Morgan to this and then they say, oh, that's a crap stock. No. You have to compare apples to apples. That's the important part. Now, look, we're going to continue in a second because we have 5 more stocks to cover, the small to medium granny shots of Tom Lee. But before we do, we have a very special sale here on Stock MVP, the tool I'm using to analyze this stock. Use the code Friday36. It's on the screen right now and in the description to get it 36% off the annual Stock MVP subscription. If you do it in the next few days, 36% off with the code Friday36. Let's continue. Now, the first stock on the list is Hims & Hers. And as I mentioned in the beginning of the video, this stock is no stranger to this channel. About 3 years ago in September of 2021, when this was an $8 stock, it's currently $30, we put out a video saying, hey, this is a really good stock. Now, obviously, 3 years later, if you've been on this stock, you've made a lot of money, that's good for you. But now we have to look at it from an objective perspective, whether it is a good investment at $30 today. And that's a whole different question than the one that I answered in September of 2021. Now, the stock is growing at 56%, which is phenomenal. Free cash flow actually grew by 500% over the past 12 months, which is insane. We have $250 million of cash versus virtually no debt, like $11 million of debt. And the score MVP is about 75, which is not bad. Not the best score we've seen, but okay. Mainly because of lower margins, high short interest with 17%, and a high PE. And that's okay because the company is still scaling. It's currently operating on a 3% operating margin, which is extremely low. It needs to come up significantly. And at 40 forward PE, this is insane. It's a very expensive company, but then again, it is what it is. It's just what happens when you find excellent companies, which everybody want to own. You're always going to have a premium. Now, the reverse DCF we ran on the stock basically assumes that the current $30 price assumes a 45% growth in revenues every single year for the next 5 years. Currently, they're growing at 56%, so that is in line. But whether they can keep that percentage over the next 5 years, that's the big question. Our 5-year price target for this company ranges from $75 per share to $150 on the bullish case and $112 in the medium case. Again, You have to understand the company first. Don't invest because some model told you that this price is going to go up. We're talking about a lot of uncertainty. We're talking about a lot of risks. You don't ever want to be buying a stock because someone on YouTube or CNBC or X told you that's a great stock. Do the work. Now, the next stock is IES Holdings. It actually scored phenomenally, 85 on the stock MVP scorecard. That is incredible. Slightly high short interest with 8%. Not horrible, but slightly high. That lowered the score a little bit. The margin is 7.6%. Again, very close to that 10% threshold, which we have here to give it the full score. And the P is at 26, which is a little bit higher. Nothing that bad. Like an 85 score is very, very high. And still, we're talking about a company with 18% growth, revenue growth, 100% net income growth over the past 12 months, and an operating margin in the double digits with 11%. And the crazy part about this is that the current share price of $287 per share assumes a 13% growth rate for the next 5 years. That's not exuberant. In fact, it is below the current growth rate of the company. So that company actually, I'm curious about. I'm curious about it genuinely. I would definitely want to more research and discussion about this company. And if you know more about it, put in the comments. I would love to hear your expert opinion in the comments because everybody in the YouTube comment section is an expert. Our 5-year model, 5-year prediction for the stock on Stock MVP is $380 for the bear case, $422 for the medium case, and $464 for the bull case. Now, let's move on to Sterling Infrastructure. 85 score as well here. 8.7% margin, which took down the score ever so slightly, and a 32 PE. Again, very similar to the previous stock we talked about. Just on the brink of scoring 90.95, but still a very, very good score. The problem here with this stock, which does not excite me, is that 8.7% growth rate, which is not that great because especially if you look at the reverse DCF, this current price of $195 per share assumes a 17% growth rate for the next 5 years, which is double than what the stock is currently growing at. So not really for me. Now let's move on to the next stock, Applied Industrial Technologies. I'm going to be honest with you, not that excited about the stock. The name is on the screen. The ticker is on the screen. With my thick accent, I got to do this. They're not growing enough. 1% growth, 10% free cash flow margin, 11% operating margin, 26 forward PE. And more debt than cash. That's a pass for me. Sorry. Now let's go to US Lime and Minerals. This is a stock that scored 80 on our scorecard, which is not bad. But the problem here, again, you have a lot of assumed success here. The current reverse DCF is a 22% assumed growth. They're currently growing at 10%. You'd have to assume a lot of success. But then again, this is a company that's going to give you almost 40% operating margin, which is insane. And way more cash than that. $250 million of cash and only $5 million of debt. And plus 44% growth in net income for the past year. So not a bad company at all. If you can assume that 22% growth for the next 5 years, everything else looks great. Now, the current price is $153 per share. Our model says in the next 5 years, it's going to go to $169 in the bear case, $214 in the medium case, and $258 in the bull case. Now, if you want to do this with us every single day in the Academy, I urge you to join, but this time I actually have a special offer for you. Use the code BF35, Black Friday 35, to get a 35% discount on all of our annual memberships for the Academy. The Elite and the regular, whatever you choose, the annual is now 35% off until Tuesday. All the details are below, patreon.com/Tom Nash. And the best part about this, you can actually try it out for 30 days and get your money back because every single member that joins the Academy has 30 days, money back guaranteed, no questions asked. I would love to see you in our Academy, talk about these stocks, other stocks, how to become a better long-term investor. This is my passion, and I guess you can see it in these videos. Would love to get you in the Academy and become part of our community. We have a phenomenal Discord, almost 20,000 members there. Would love to see you there as well. Thank you so much. Have a great weekend. I'll see you next one. Peace.